Thank you for getting up bright and early today after last night's big party. I'd like to welcome you to the New York Metro Area Flood Insurance Update. This is a CE session. It runs from 8 to 9:30. You will get 1.5 hours of CE credit. And just please be sure to fill out your evaluation form and to submit your yellow CE card with Shanita when you leave the program, okay? And it's my pleasure this morning to introduce our speakers all the way up from New York City. We've been talking about this program for many months now, almost all year. So we're excited that they're here with us today. First, I'd like to introduce Dana Kochnower, who is the Assistant Director for Policy, Land Use, and Buildings with the New York City Mayor's Office of Recovery and Resiliency. She works with a staff of 30 appointed by Mayor de Blasio, implementing the city's $20 billion resiliency plan to adapt New York City's buildings, infrastructure, and coastal defenses to the evolving risks associated with climate change. And with Dana this morning is Tallant, or as we know her, Tally Burley. Tally is a policy advisor with the New York City Mayor's Office of Resiliency, where she works to increase flood insurance enrollment in New York City through coordination with city agencies, elected officials, and stakeholders, and engagement with communities. So please join me in welcoming this morning Dana and Tally, and enjoy the program.
Thank you all for joining us. As you can see up on the screen, if you've just walked in, we're trying to create a word cloud. So if you just go on your smartphone to menti.com, you don't have to download anything. It's just a regular web page. And there's a prompt for the code, for that code up on top. And then it's going to ask you just to put in a word or two of what you're hearing. We're really interested in what you're hearing from your clients in your everyday interactions. And you can see, there's just general concerns about, obviously, finances and down payment and costs. And then there's some more specific ones around flood zone. But if anybody hasn't got a chance yet to answer that, we'd love to hear what you're hearing. And thank you all for joining us today. I'm Dana, and this is Tally. We have a really informative presentation for you, and we would just love, there's definitely going to be questions, and we want to answer everybody's questions, so if you could just write them down throughout, and then we'll be able to leave some time at the end for a bit of discussion and question and answer. And if you're just joining us, we're just asking you to participate in our word cloud. So if you can go to menti.com, put in the code, and then just put in a word or two. And we're really, really interested in, in hearing from you what you're hearing from your clients. Snapshot. So as you're all, putting in these concerns that you're hearing, we wanted to be able to show you how this all relates to flood risk and flood insurance. And so, concerns around closing costs, concerns around extra homeowner costs, those are all affected by flood risk and flood insurance because they do ultimately add up, in the carrying cost of a home. Closing times, we'll get to that a little bit further into the presentation. When the National Flood Insurance Program is at risk of not being reauthorized, which is where we are right now, waiting for reauthorization. And if you cannot get a flood insurance policy, that can potentially hold up the closing period. Concerns about, rising rates and unexpected fees. These all really, really relate directly to flood insurance. So if everybody's gotten a chance to participate in this, we'll get started. So thank you all for taking a minute. Yeah.
Great. So as Dana said, just as we begin, a couple housekeeping items. We're not going to be taking questions during the training, but we will at the end, so make note. There's a lot of material we're going to cover. And a lot of the things that Dana was just alluding to in the word cloud are also things that we're going to go over and touch upon during the training. And then finally, just keep in mind, we are from the New York City Mayor's Office of Resiliency. We are not from Fema, and we are not insurance experts, and so we can talk about the impacts of flood risk and flood insurance on our communities and what we have seen through analysis and research, but specifics about specific policies and about specific programs within NFIP beyond what we see in our communities are not necessarily things that we can speak to directly. So as Priscilla mentioned in her introduction, the New York City Mayor's Office of Resiliency is dedicated to climate adaptation. We look at all climate hazards and ways to make the city stronger, both the buildings and the people and the infrastructure. Our focus is flood, but there are people in our office who are also working on issues like heat, and we work across all sectors. So people in our office are looking and working on policies and programs related to housing, land use, infrastructure, and even things like social cohesion. So New York City, as many of you, all of you likely know, is at the southern tip of the state of New York. We have 5 boroughs: Brooklyn, Queens, Manhattan, the Bronx, and Staten Island, and we have 520 miles of coastline within the city. So a lot of our communities are at risk of flooding and face flooding risks on a day-to-day basis. So it's very, very acute to their day-to-day lives. But flooding is not something that is just happening in New York City, and flood risk is not something that's just happening in New York City. As you can see from this graphic, this is a map that Fema has produced, and they have produced similar maps for every state across the country. Pretty much every county in New York State between 1996 and 2016 experienced a flood, or more than one flood. And if we look even closer at that higher bracket that they've identified, which are counties that have experienced 35 floods or more, we have 36 counties across New York State that have experienced that many flood events or more than that, which means that they're averaging over a flood a year. So this is something that is impacting people everywhere and on a pretty frequent basis. And certain places are seeing increasing floods, like Nassau County, Rockland, Broome County, but flooding is very, very, as I said, acute, and that makes things like flood insurance really, really critical and important to help people bounce back. It is an important tool in the toolbox that people have. We're going to take a minute. Before we do, though, so I just want to say, so during a flood event, in addition to flood insurance, sometimes there will be a federal disaster that is declared and federal funds will be released that comes in the form of things like FEMA, HUD money, special small business administration funds. And so before we get into the nuances of that, we just want to ask you, and Dana's going to pull up another Mentee poll, about how much on average do you think somebody is receiving from federal disaster assistance like FEMA after a disaster has occurred?
I'm sorry, I just didn't know which way to get out. And then you can go back, right?
Yeah.
All right.
Okay. Great. So a lot of your responses were in that 15,000 range. And what we actually tend to see is something a little bit different. So many people often think that federal disaster assistance is going to provide a substantial amount of money following a flood event to help people recover, repair, and rebuild faster. And what we actually see is that in New York State, within that 1996 to 2016 period we were looking at on those maps, FEMA individual assistance, which is one of those types of federal disaster assistance, was giving payouts of only about $8,000, so a little bit less than what you all were saying about on average. Flood insurance, on the other hand, were resulting in payments of about $50,000 per claim. And that is over a 30-year period. In an event like we saw in New York City from Sandy, the numbers are even a little bit more stark. People received about $68,000 from NFIP, so from flood insurance, compared to only about $3,500 from FEMA individual assistance. And so this tells us that flood insurance can go an incredibly long way to helping people recover, repair, and rebuild after a flood event. The other thing to keep in mind is that federal disaster assistance is only available to people when a federal disaster is declared following a flood, whereas flood insurance is available to people regardless of the flood event. If it floods and they have flood insurance, they can submit claims and potentially receive payments. It also, when we say it goes a long way, 1 inch of water can cause about $25,000 worth of damage on a property. It's a lot of damage for a little amount of water. And so the assistance that is going to get you the furthest to help you recover and rebuild is really going to be insurance, which is going to at least make you whole, almost whole or partly whole, whereas disaster assistance is only going to cover a fraction of those potential expenses. Given that it is such a benefit to increasing not just the physical resiliency of a property, but the financial resiliency of individuals, it's really, really critical that people in communities living in floodplains or thinking about living in or near a floodplain are aware of those flood risks, aware of the benefits of flood insurance, and aware of the potential requirements that come with flood insurance. Flood risk across the country is increasing, and we're going to talk a little bit more about that further on in the training. But with that increasing risk, this becomes increasingly important. Additionally, flood insurance is a federal program, and so it comes with specific federal rules and requirements, and things like the amount somebody pays is tied to these federal rules and requirements, and then there are a lot of properties that are also required to purchase and maintain flood insurance, which we will speak about further. And there have been changes to the program that have impacted the affordability of flood insurance for people across the country. So today, through this training, we're going to walk through these areas. We'll talk about the increasing risk. We're going to review a flood map, what it is, what the components are, and how to read it. Dana's then going to speak about the National Flood Insurance Program and flood insurance affordability. And then we are going to share some of the tools and resources that we have available to us in the city and that are available across the state and across the country to help people understand risk and flood insurance. So when we say that flood risk is increasing, this is not something that is happening in the future. It is already happening today, and we are already seeing the impacts of it today. In New York City, we have already seen over a foot of sea level rise since 1900, which is twice the global average. And risk is increasing and has increased, both not just due to coastal conditions like sea level rise, but in riverine communities and due to precipitation and increased precipitation. And we know from the New York City panel on climate change that sea level rise is expected to continue to increase over time. And these are projections that are done through a 100-mile radius. They are downscaled from international projections, and they are the same projections used for New York State. So by 2050, we could see anywhere from a foot to a foot and a half of sea level rise, and by 2100, as much as 6 feet of sea level rise. I am roughly 5 feet tall. Many of you in this room may be about 6 feet tall. For me, that means that sea level rise by 2100 is going to surpass me by a foot. That is fairly substantial. And what this means is that our floodplain is expanding as sea level rises, and that means that more land ends up being in the floodplain, we have more buildings in the floodplain, and we have more people living in and near the floodplain. Additionally, for our coastal communities, it means that the frequency and intensity of coastal flooding is going to increase as well, and that is absent of any changes to storms themselves. So we hear a lot in the news about consistent and more frequent hurricanes and large storms happening. Even if we remove that factor, in a lot of these communities, we are going to see increased flooding, impacting potentially people's day-to-day lives and occurring on sunny days when the tide is coming up higher and faster. So the best indicator of current flood risk are maps developed by Fema as part of the National Flood Insurance Program called Flood Insurance Rate Maps. We have passed out and provided a handout that is a copy of a flood insurance rate map. I encourage everybody as we are talking about these maps to sort of have it handy and refer to it. The copy that we provided is,
What's the year on the map?
so I'm gonna get there. We haven't got, we'll get there. It's gonna, don't worry. But so the copy that I have provided is a copy of a flood insurance rate map in New York City for a community in Queens called Broad Channel. This is a community that is right on the coast. It is primarily single-family detached homes, and it was severely impacted by Sandy. These maps depict current risk, and they do not take into account that increasing risk that we were just talking about. They are essentially a snapshot in time. FEMA develops them using historic weather modeling and the topography at that time. And so in many ways, because we know that risk is increasing and that things change over time, the moment the maps are printed, in a lot of ways they are outdated. That being said, they provide a lot of critical information and useful information to understanding risk, and they play a very critical role in flood insurance. And so the maps are really doing three things. The first is that they are defining flood risks and hazards. In particular, they are showing what is called often the 100-year floodplain or the special flood hazard area. This is an incredibly misleading term. We try not to use it. It does not mean that a flood is going to happen every 100 years. In reality, it means that a property in one of these areas has a 1% annual chance of flooding, or I think a more sort of profound way to look at it is that over the course of a 30-year mortgage, a property has a 26% chance of flooding. That's fairly substantial, and so these properties, these areas, have a high risk of flooding. In addition, the second really big role that these maps have is to determine flood insurance rates and requirements. Properties that are in higher risk areas of flooding typically face higher flood insurance rates. And additionally, properties in high risk areas of flooding face what is called a mandatory purchase requirement for flood insurance. So this requirement is tied to properties that have a federally backed mortgage. So long as the property has that mortgage, they are required to purchase and maintain flood insurance. And this requirement is also tied to properties that have ever received federal disaster assistance. This federal disaster assistance requirement is tied to the property in perpetuity. And if they do not continue to purchase and maintain flood insurance, they risk being ineligible for future disaster assistance. So what this means is that even if somebody received federal disaster assistance 15 years ago and they have since sold their property, that new owner is still required to purchase and maintain flood insurance on the property, and any future owner is required to. And even though those new owners were not the ones who applied for and received any sort of disaster assistance, they would still potentially be ineligible for future assistance if they were not carrying flood insurance. The third role that these maps play is to inform building code standards in the floodplain. So the information provided on these maps is really designed as a minimum standard. Properties in areas at high risk of flooding have a different building code requirement to help minimize flood risk for those properties that are being built and substantially improved within the floodplain. And so the information on the maps is that minimum standard. So if you look at a map, they are often very complicated to look at and read, even for people who are practitioners in the field. There are a lot of lines and numbers and letters and crosshatching. The easiest way to sort of understand them and to read them is to parse out the different components and walk through them that way. And when we do that, we see that there are really two distinct floodplains. There's that 100-year floodplain, those areas at high risk of flooding that I was talking about before. And then there's a 500-year floodplain, which are properties that have a moderate risk of flooding. And these two floodplains are distinctly shown on the maps. Any properties that are outside of these areas, I just want to flag, it does not mean that they cannot flood. Where it can rain, it can flood. Just based on the analysis that Fema has done to produce these maps, they are shown as having a minimal risk. Now, within these floodplains, the maps are also defining flood hazards, and those are shown using what are called flood zones. Now, depending on the type of community you are in, you have different flood zones to identify the different risks. In New York City, again, we are predominantly a coastal community, and so we are dealing with pretty much 3 flood zones that I'm going to walk through. Riverine communities have different flood zones because the risk is a little bit different and the hazard is different, and I'm not going to speak about those today. So if we start at the coast and work our way inland, we can really start to see how the hazard shifts and changes over time. So starting at the coast, we start in what is called a V zone. These are areas that are at high risk of flooding. They are close enough to the coastline that in addition to water coming in along the land during a flood event, they may also see wave action coming down upon the properties, fairly substantial in some cases. If you move a little bit further inland, you are still in an area at high risk of flooding. You have moved into what is called an A zone, though, and water is still going to come in along the land during a flood event, and there's still a possibility of some waves coming down on the property, but they're not going to be as intense as they would be if you were in a V zone. When we move out of the 100-year floodplain into the 500-year floodplain, we are in what is called an X zone. And these are areas that are far enough away from the source of the coastal flooding that you're not going to see waves coming down on the property, but you can still easily see water coming in along the land, causing damage to a property during a flood event. So if you look at the maps and you see these letters, you see AE, VE, X, those correspond to these different flood zones that are identifying the different hazards, the hazards in that community and that area. Also on the maps are numbers, and those numbers represent what is called a base flood elevation, which is a fancy way of saying the height to which the water is going to rise during a flood event. That is a measurement that is measured from sea level, and base flood elevations are only provided for properties in the 100-year floodplain in areas at high risk of flooding. And they play a critical role in informing those building code standards that we spoke about before. So in New York City, up until Hurricane Sandy, the best indicator of the city's coastal vulnerability were flood maps developed by FEMA in 1983 when the city joined the National Flood Insurance Program. These maps were digitized in 2007. We refer to them often as the 2007 flood insurance rate maps in the city, or 2007 FIRM, but none of the information when they were digitized changed. That's not to say that the maps aren't showing that there are a substantial number of people living within the city's floodplain. Based on these maps, it's about 200,000 people, about 36,000 buildings. And these are the maps that are still used in New York City for flood insurance purposes today. But as we discussed, in many ways, once a map is created, it's already outdated because things change. And so by the time Sandy came around, these maps had already been around for 30 years, and no information on the maps had changed. So they were, in a sense, outdated. And we saw that during Hurricane Sandy. So this orange marker that you can see on these maps is the extent that the water inundated during the storm, which far surpasses the blue area, which is the map that we were just looking at before, that 2007 firm. So the water went further. There were a lot of people that were at risk of flooding who were not necessarily aware of their risk because of the older maps, and they were not necessarily aware or cognizant of the fact that flood insurance would be beneficial to them. This also tells us that even though we have a map, floods do not abide by the lines on a map. They play by their own rules. And so even if you are shown as being an area at moderate risk of flooding, you might be across the street from an area at high risk of flooding and still really have a risk that you should be aware of and cognizant of, especially given potential costs that may come should the property be damaged over time. Now, at the time of Hurricane Sandy, FEMA was in the process of updating New York City's flood maps for the first time since 1983. Following the storm, they released a series of preliminary maps which showed an extensively expanded floodplain. We went from about 200,000 people shown as being in the flood zone, in the floodplain, to about 400,000 people and 36,000 buildings to 71,000 buildings. So we essentially doubled the size of the floodplain based on these preliminary maps. In order to help with the recovery and rebuilding effort, these 2015 preliminary maps were adopted for building code purposes. We wanted to make sure that people were rebuilding using the best and highest standard of information available, in part because we knew that the risk had actually increased. At the same time, we also wanted to do our due diligence to ensure the accuracy of these maps. And so the city reviewed the maps and found errors in FEMA's modeling, and we appealed the maps and won our appeal of these preliminary maps, which puts New York City in a somewhat unique position. Instead of having one map that is informing flood insurance purposes and building code standards, right now in New York City, we have two. We have the 2007 map being used for insurance purposes, and we have the 2015 map being used for building code purposes. And it's going to continue to be that way in New York City until about 2022. FEMA is currently in the process of revising the city's maps, using more precise data and analysis, and is anticipating to have new maps by about 2022. So the city appealed our maps, and while we're in a unique situation with our maps, in part because of that appeal, appeals are not something that are unique to New York City. They can happen anywhere. When FEMA produces preliminary maps, a community has a period in which they can review and appeal the maps for scientific and technical reasons. Things like the floodplain boundaries, the flood zone designations, and the base flood elevations. And so an appeal can be something that any community anywhere can come across and should just be aware of that potential in the future. Now, we acknowledge that our current map situation in New York City can be very, very confusing to people trying to understand their flood risk and people who are potentially looking to purchase property in an area and understand what that risk is. And so we're going to walk through just a case example that we see in the city. We actually know nothing about the true flood history or flood insurance of this property, but where it sits on the map is very, very similar to what we see for a lot of properties across the city. So this is a property in Staten Island. According to the 2007 map, it is in an X zone, so it has a moderate risk of flooding. There's no requirement that they purchase flood insurance because they're in that moderate risk zone, and they can purchase it at a relatively affordable cost. Now, based on the preliminary maps, this property is going to be in an area at high risk of flooding, which means that should the maps that FEMA produces in the end look the same, this property will now have a requirement to purchase flood insurance, and it will face higher flood insurance rates. That being said, if this property owner or a future property owner purchases flood insurance today, while this property is still in an area at moderate risk of flooding, they can do so at a relatively affordable cost. And even after the maps change and they are mapped into an area at higher risk of flooding, they can maintain that rating. What's also pretty exciting and interesting is that even if they sell their home, that rating can be passed down with the sale of the property. So if we look a little bit closer at what this property looks like on the maps, it can also tell us a lot about the sort of overall story of the flood maps and how to read them. So the map on the right of the screen is a digital version of a flood insurance rate map. Brown on the digital maps typically means areas at moderate risk of flooding. And as you can see, this property is sort of right in the middle of a moderate risk area of flooding. But it's also not very far from area of high risk of flooding. And because we know risk changes, this property would benefit from understanding their risk and the nearby risk of properties around them, and probably knowing that flood insurance is available to them as well, should they experience damage in the future. If we look at the preliminary maps, we can see that the flood boundary has shifted fairly significantly. And so not only is this property now shown as being in an area at high risk of flooding, and not only is that small band that we saw of properties an area at moderate risk of flooding in there, but it's kind of surpassed that as well. And so when we look at the maps, we can see how the risk has changed, and we can also understand potential risk moving forward. I'm going to hand it off to Dana.
That last slide, the average flood insurance, the average flood for that particular home being transferable, how much would that roughly be?
So a moderate risk policy comes with what's called a preferred risk rate, and that could be as low as $500 a year. There's eligibility requirements for that. But again, this is why buying in, if you're in a moderate risk zone, buying in and maintaining a policy can be really beneficial, especially through the sale of a home and the transfer of that policy. It's called grandfathering in the flood insurance program.
So would you recommend to this property owner, before they put the house up for sale, would you recommend a, what do they call that, a elevation certificate?
So I'm going to get to that in a few minutes, but good lead-in. You just got a really robust education in flood insurance rate maps. I'm going to talk through a little bit about the program in general, and then we'll get to some issues like elevation certificates in a minute. So the National Flood Insurance Program, as Tally mentioned, is a federal program. It is voluntary, and it is based on an agreement, so basically a handshake between the federal government and a local community. Community is defined by NFIP in a number of ways. New York City, for instance, is one community. Even though we have a large population, we are considered one community. Across the state, communities can vary by municipality. In exchange for adopting and enforcing sound floodplain management regulations, so what Tally just described as building code regulations, and ways of managing risk in the floodplain and building there, federally backed flood insurance is made available to every property and renter in that community, whether you're inside the floodplain or outside the floodplain. The only restrictions really are if homes are built entirely over water, and that's kind of a different story. Flood insurance is not included in homeowners insurance, and we cannot emphasize this enough. It is a separate policy. There's a lot of confusion, and I'll explain in a minute why there's a lot of confusion, but something we saw after Hurricane Sandy in the city was a lot of homeowners thought they were covered, and they weren't. And then, as Tally has been talking about, it is federally required for some properties. So properties that have a federally backed mortgage and are located in the high-risk area must purchase and maintain flood insurance, and properties that have received disaster assistance in the past must purchase and maintain flood insurance. And from what we experienced in Sandy, that notification is actually at the time of another disaster. So a homeowner may not understand that there was this requirement, and then a disaster hits, they apply, and they've been told, you know, you had this requirement on your home. So the National Flood Insurance Program is actually broken out into structural or buildings policies and personal contents coverage. It is available for renters. Tenants can purchase coverage contents up to $100,000. Business owners that are renting in commercial properties can purchase coverage contents for up to $500,000. For a residential structure, the limit is $250,000 for structural, and then $100,000 for coverage. And multifamily buildings and commercial properties can also purchase coverage. Those have slightly higher limits. And again, just making this point of how much flood damage can actually cost. Just 1 inch of water can cause $25,000 of damage. Thank you. And this gets at why this is so confusing for consumers. So FEMA administers the National Flood Insurance Program. They underwrite almost all residential flood risk. But at point of purchase for flood insurance, you're going to what are called write your owns. FEMA doesn't want to be running an insurance agency. They work with regular insurance agencies that are also selling homeowners insurance. And so it's not always clear when people are purchasing their flood insurance, you know, I got it from the same person that I got my homeowner's insurance, I'm covered. And so it just adds to this confusion around whether or not you're actually covered. And basically what they are middlemen in a way. They're using all FEMA guidance to rate and issue claims, but they're the point of purchase there. So we're just going to take a minute to do a little history lesson, and it really helps to walk through this to understand how we got to where we are currently with flood insurance. So there used to be a private market for flood insurance, and one is kind of rebuilding now. Back in 1927, there was a private market. There was the Great Mississippi Flood, which was so large at the time it wiped out about 1/3 of GDP. And the private market said, okay, this is too risky. We're pulling out of covering flood. For the next approximately 40 years, the federal government was responding to floods on an event-by-event basis, but all the time considering developing a program where people would be paying in. And so in 1968, they developed the National Flood Insurance Program. At the time, it was created under HUD. At the time that the program was created, there was an understanding that there were a lot of communities that were already built without really understanding their risk. And that's where this subsidized rate, if you've heard about the subsidized rates for flood insurance, that's where it first came in. Because they said you shouldn't be penalized for living in a building before you really understood your risk. And so they issue what is called pre-FIRM or pre-flood insurance rate map subsidies. Those are still in place today. From 1968 to 1973, nobody was buying flood insurance. And so they instituted the mandatory flood insurance purchase requirements we've mentioned a couple of times. 1979, the program moved over to FEMA, where it still is today. 1983, New York City adopted its first flood insurance rate map. New York City, along with a lot of other communities, was built before 1983. So nationwide, FEMA will say about 20% of policies are those subsidized, pre-FIRM, pre-understanding of risk policies. In New York City, that's flipped. About 80% of our policies are buildings that were built before understanding the risk. In 2005, Hurricane Katrina and Rita hit. For that period in between, the program was operating pretty much as it was designed. Some years it paid out more, some years it paid out less. 2005 really marks a catastrophic year, and it threw the program into debt, approximately $17 billion worth of debt at that time. And what we've seen since then with more, intense storms is that that debt kind of keeps piling up. In 2005, among growing concern about the solvency of the program, Congress acted, and they passed the Biggert-Waters Act, which I will talk a little bit more about. But what that did basically was repeal the subsidies that have been in place for so long in order to ensure the solvency of the program. 2012 is when Hurricane Sandy also hit the Northeast. So for people in our community, it was kind of this 1-2 punch. Rates were increasing at the same time that they're trying to recover from a storm. 2014, Congress acted again. There was a lot of backlash after Biggert-Waters passed. And in 2014, Congress acted again and passed the Homeowner Flood Insurance Affordability Act. I'll talk a little bit about what that means. And then in 2017, the program expired, and we've been in a reauthorization period since then. There have been 12 short-term reauthorizations in Congress of the program. And what this means, every time the program is at risk of not being reauthorized, there are impacts on real estate. Basically, people with this mandatory purchase requirement tied to their mortgage are in limbo until they're assured that they can purchase flood insurance. And we saw this not too long ago. The program actually lapsed for I think it was a couple of days, and it really holds up closing, and it holds up purchases. The program is set to expire again September 30th. And so how are rates determined? So rates are based on, as we've discussed, the year of construction, whether or not your structure was built before the maps or after the maps, the flood zone, where a structure is located, the relationship between the lowest living floor and that base flood elevation, or that potential height of floodwaters as indicated on the maps, and if there are any floodproofing measures in a home. Yes? Yeah. We can share also. So this is where we get to the elevation certificate. So an elevation certificate is a product. It's a form created by Fema, and it captures a lot of what affects flood rates. Basically how it works is a licensed surveyor or an engineer comes to the home, they measure the height of the lowest living space, they measure other things like mechanical equipment, and the ground outside of the home, and then they complete an elevation certificate. This is the property of the homeowner. And the homeowner can take it to an insurance agent, and an insurance agent will rate the home based on this. So the way that it works is that gives the homeowner a view of the full risk rate of a home. If that home is receiving a subsidized rate, they're getting a one-size-fits-all rate that's kind of in a black box. With this, they're getting a structure-specific rate. In New York City, as I said, about 80% of our buildings are getting that kind of black box rate. That we've seen 3 out of 4 homeowners are actually saving money by getting an elevation certificate and understanding their full risk. It might not benefit everyone, and there are protections because the law dictates that you have to be charged the lower of the 2 rates, but it is information, and it's information that can be really useful to future owners as well. And if if a homeowner invests in an elevation certificate, it's approximately, in the New York City market, it's approximately an $800 to $1,000 cost. They can pass that elevation certificate along in a sale. They know what that full risk rate is. And the goal for FEMA, for a National Flood Insurance Program, is to move every home eventually to that full risk rate. They are pulling back these subsidies. And if there's a seller, one more note on elevation certificates, if there's a buyer, they can ask a seller if they have an elevation certificate, and if not, they can ask a seller if they would get an elevation certificate for the home. And so FEMA views mitigation of flood risk through elevation, basically. FEMA wants everyone up and out of the floodplain, right? They want every home up, and there's no property at risk of water coming in. And they rate based on this. So as you can see from this chart, elevating your home can lower your premiums. This is what this line here, this is base flood elevation. This is those projected height of floodwaters in a flood. At the far left, you see a home where the living space is below that base flood elevation is at high risk, and they're being rated accordingly. As they're elevating above that base flood elevation, their risk is going down. An elevation certificate is basically documenting this. And this is what FEMA recognizes nationally as the gold standard for mitigating risk for a home, and what they encourage and will give you the most substantial premium credits for. However, in New York City, in a lot of older communities, in a lot of urban communities, this kind of mitigation is really difficult. It's physically difficult, it's financially really difficult, it's very costly. And then there are other trade-offs that come along with it, like a loss of living space, a loss of storage, a loss of potential rental income from renting out an apartment that might be on a lower living space. And so this is just a variety. These on the right, these are New York City specific. The top one is a large multifamily building. The bottom one are attached homes. In Brooklyn, on the left, these are other communities that are facing similar challenges. Pennsylvania, townhomes and attached homes, and then just homes that are built on smaller lots as well. Other challenges with this kind of mitigation are accessibility. And for some older residents, they don't necessarily want to be climbing 12 steps when they thought they had a first floor home. So people have a lot of reasons for why this is a particular challenge for them. And then this leads to some of the affordability challenges that we've been seeing in our community. So the first one, there's three challenges that are basically impacting affordability. The first one is increasing risk, which we talked about with the maps, and then also just with changing risk over time. The second one are these mitigation challenges that I just talked about. Not every building can be elevated up out of the floodplain. And then the third one are these legislative changes that we are currently experiencing right now. And again, these are not unique to New York City. So, as I said, prior to 2012, the NFIP was in debt following these large payouts from Katrina and other storms. And at the same time, these subsidized rates that I've been talking about are really failing to adequately reflect the actual flood risk. They're not really serving as a price signal of the true carrying costs of a home that's located in a high-risk area. In 2012, Congress acted and they passed the Biggert-Waters Flood Insurance Reform Act. They removed those longstanding subsidies. At the time, the trigger was the sale of a home or the lapse of a policy. And at the same time, they required banks to enforce the purchase requirements more stringently. And so homeowners were being kind of stuck in between having their rates go up and having their banks enforce that they needed to carry these policies. In 2014, due to a lot of backlash, partially the impact on real estate sales because of the trigger at that point of sale, the Congress passed the Homeowner Flood Insurance Affordability Act in response to these affordability concerns. And so they kept these, they kept the repeal of the subsidies in place, but they changed the trigger. And what they did was they capped the rate increases annually at 18% a year. And that's still a lot of money for people. What we've seen on average over the past couple of years is closer to about a 5% increase, but there's still an increase every year. The rates are going up, especially for homes without an elevation certificate who are in that subsidized rate category. Those rates will continue to go up. There are new changes afoot within FEMA and the National Flood Insurance Program. One of them is called Risk Rating 2.0. We're not going to go into a lot of detail because there aren't a lot of details about it, but it's supposed to be coming out in the next year or so, and it will change the way that flood insurance is rated for residential single-family structures. And that, again, raises the concern about those annual increases. So in New York City, we have been very concerned about affordability issues, especially in our waterfront communities where it's not all wealthy second homeowners. It's a lot of our lower income populations. And it's also just been areas where, you know, people have been able to buy a single family home historically. And what we've seen, so we studied what the impacts of flood insurance affordability is on these communities. And as a part of that pity ratio, so the carrying cost of a home with insurance and taxes and mortgage, and what we've seen is that as flood insurance increases, it can kick some people over into being housing cost burden, so spending more than 30 or 40% of their income on those basic housing costs. Again, this highlights what is our concern, which is people who not only currently own, but people who are buying into these communities and really understanding just what their true costs are of owning a home.
So over the past few years, especially as we've seen increasing flood events across the country, a lot of communities and nonprofits and even the private sector have started to develop these online tools and other platforms to help people understand their flood risk and flood insurance. In New York City, our main tool is called floodhelpny.org. We have postcards that we can pass out at the end as well. This is created through the Center for New York City Neighborhoods, which is a nonprofit that the city works closely with. It is an address lookup tool, and it has a lot of resources on it. On the flip side of Flood Help, they also run a resiliency audit program. We're not going to touch upon that really as much today. This is only available in select communities in New York City, but an engineer would come out, do a survey of the home, and identify feasible resiliency measures, and then applicants in that program who are eligible receive a free elevation certificate and free flood insurance counseling. But what we did want to do today is share and go over Flood Help so you can see sort of the tool that we have available to us in New York City. So this is Flood Help. Scroll down, and they have a map feature, as I said, so it's an address lookup tool. And so we're just going to put in the address that we were looking at in Staten Island before. And what it does is for New York City, especially with our unique map situation, it's going to tell you where the property is on those 2007 maps, and then also where it's anticipated to be based on the preliminary maps that we've seen. So it gives you this information. It says you don't currently have to have flood insurance, but you may need it in the future given this change. And where's the map? And then you have the map, and you can actually move around on the map and see how different areas have changed. You can flip between the current map and the advisory map, and so visually see that change as well. In addition, if you scroll down, there's just more information, what you should know, and questions you may be asking yourself as you're sort of scrolling through and thinking about flood risk. And then at the top, they have these resources, so understanding flood insurance. It's pretty comprehensive. There's a lot of information on here, and they're actually continually starting to update and add additional information as well. And then again, you have your map where you can look up your address. And then other tools and resources. And so this is useful for people who are living in these communities. It's useful for people who may want to purchase a property in these areas to get a sense of what's happening and some of the sort of nuances to the program and to flood insurance. So that's what we have in New York City. The other sort of tool that everyone has at their disposal is Fema and Fema's Map Center. Admittedly, it's not 100% user-friendly and can be kind of hard to navigate, but the map itself is there. And so again, you can type in your property. And it will pop up with the map currently in effect for that community. And so you can see a digital version of it. Unlike what we have as a tool in New York City with flood help, this is only going to show you that current map that's being used for flood insurance purposes. And so if there's a preliminary product, you kind of have to dig a little bit further into FEMA, and it can be really, really hard to find.
But you can see how close a property is
Yes.
to.
That would be the 2007 map.
Correct. Correct. So if you dig into FEMA, you can pull up the preliminary panels. You have to download them one at a time, so you really have to know where you are. But for insurance purposes, because this is the map on the books right now, it is at least giving you that snapshot. And as Dana said, you can see how close a property is to the firm based on this information that we have available, and get a sense of the risk. And there's other information on here as well. They have a show all products, and then you'd be able to open it, and you can open it, the map itself, into a single viewer as well.
Can you say what the actual benefit of the FEMA map would be? Because it sounds like it's...
So the actual benefit, the actual benefit of the FEMA map is that it is official, and it is what's used to inform flood insurance. And so when you're thinking about how much somebody might have to pay, like an additional expense they need to think about, that's the map that's going to sort of guide those costs, at least right now, especially if somebody's purchased flood insurance already and they're in one of those lower risk areas. The preliminary maps are going to tell you how risk is going to change. And again, we know that risk is changing, but for costs and for flood insurance, these effective FEMA maps are the way to go. They're just hard to read, unfortunately, and we can't do a lot about that. What we can do is us as a community and other communities and nonprofits try to make user-friendly tools that make it easier for people to understand and read through. And yeah, we will open it up for questions. Do you have a Menti for questions?
I do have a Menti, but we'll just
Okay.
a small group.
Okay.
So, sure. Yes,
Sorry, it's a multi-part question.
go
It's,
for it.
yeah.
September 30th is still the extension date?
Yes.
Yes.
So in a few days,
Yes.
likely just another 2 or 4 month extension, kicking the can down the road kind of thing?
It was included, the most recent that I read was it was included in another short-term bill to extend short-term, but I don't think that's been passed yet.
Yeah.
Yes, we have a few days to sit on our hands on that.
Yes.
You had mentioned the something rating 2.0 that's coming out
Yes.
sometime next year. If I have that right, FEMA has the ability to do a new risk rating. They expect it to release this by April 1st.
So they expect to release what the rates are supposed to be by April 20th. Risk rating 2.0 only applies to single-family homes, and then it would come into effect in October. There is not a lot of information out there about risk rating 2.0 aside from like a couple one-pagers.
Have the ability, to actually create a new risk assessment plan, management strategy, without anyone's authorization but their own, which makes sense. Got it. And so I think that's all part and parcel of the same thing.
It is.
So I'm just trying to connect a few dots.
It is.
You started with cost and risk.
Yes.
So being realtors, we usually figure out at some point in time there's a tax involved. Has there been discussion about spreading risk out more on the different zones?
So the goal with Risk Rating 2.0 is to move away from the in-out of the maps that we've shown and move more towards structure specific. So what they're trying to do with that is bring in a couple of other factors and actually be rating you, as we've been talking right now as it stands with the maps, you could be in an A zone and be high risk. You could be across the street and considered out of that zone. And there could be a difference in those policies of a couple of $1,000s. What FEMA is trying to do with Risk Rating 2.0 is really take into account the graduated risk. So it's not necessarily that in or out stark difference, but kind of spreading it out that way. That's part of what they're moving toward is this more holistic view and more structure specific at the same time.
So in real world terms, how we'll see it in our lives is most likely if somebody's getting a mortgage
Yes.
in a zone that has very little impact or doesn't require flood insurance at the moment, there is a chance that if you get a mortgage, there will be the requirement of a small flood insurance policy.
To the best of my knowledge right now, they are not changing the mandatory purchase requirement. They are still using the maps to dictate the mandatory purchase requirement. So A zone, that high risk zone still carries the requirement. The lower risk, moderate risk zone does not carry that requirement. This is to the best of my knowledge right now and what they've released. What they're changing are the rates. And I think over time, the move is to change that, but the mandatory purchase requirement has not,
Won't change. There's no
To my
change.
knowledge.
There's no change per zone. Okay.
but again, as we said at the beginning, we are not from FEMA. FEMA has its own world. And so, but we've also been asking for more information about Risk Rating 2.0 because it is going to change a lot of things.
Right. And from the boundaries that they have, if this is, again, a federal entity and the federal entities underwrite mortgage and the idea is spread risk out, there's a possibility that could come up in a court point. Somebody thinking around saying this makes sense.
Yes.
The other concern is spreading risk out, requiring, you said moving to full rate.
Yes.
On that. So in real and no subsidies, nothing grandfathered, full risk, you subsidize your policy based on what your exposure is. That could seriously increase the rate of individual properties.
Individual properties that are at higher risk would then be charged a higher risk rate.
And
Yes.
Just try that one together with legislative challenges. That's very good. A legislative challenge that we face is a 20% transfer tax that might come up on people who move a property in a year. If this occurs, and somebody says, I can't afford the insurance on this because the house needs to be modified, raised, etc. No one in the neighborhood can afford that rate except an investor can come in, pick up that house, do the renovations, move it, and then try to get out of it, and now it's paid a 20% tax. That's a legislative challenge we see about these two particular things coming to a head, possibly in the same time period. So hoping there's a carve-out for flood insurance that those things can occur. The flood, how we call it, flood remedy, preparing for the flood insurance rates, that would be an issue for someone to invest in a property. If the owner can't do it, the owner can no longer report it, the average person coming into the neighborhood can't afford it. An investor can remedy that situation. It makes it viable for the neighborhood. Another concern is if flood insurance becomes too expensive, and this just may be evolution, we lose waterfront homes because some neighborhoods will never have the resources to maintain residential property in a flood zone. Therefore, over a period of time, there's no waterfront properties become something else. And then sharing some of your information with other municipalities that you worked outside of the borough?
So we try to keep apprised of what's going on in other communities, both in New York State and across the country, and talk to those communities about innovative things that they might be doing that we should be aware of, and vice versa.
And then the FEMA panels, are you putting them in the software over time? No? Okay.
No, so FEMA is maintaining that FEMA website that we showed. The Center for New York City Neighborhoods and Flood Help NY has the tool that we've showed, and that will be updated when the maps are eventually updated. But that does come with a disclaimer that, you know, it's illustrative and you should always check with FEMA, which is the value of the FEMA website. It's more difficult, but it's official. Yeah.
Did you?
Yes.
Okay.
I defer to those.
Ladies, this was a very informative presentation. I really appreciate it. The point that I would just want to ask you about is the floodhelpnewyork.org and the resiliency audit, and the nice little bit that you said about having an evaluation certificate possibly not cost the homeowner
Correct.
$800,000.
Correct.
So that definitely I will take back. The other thing that I wanted to ask you was if you currently have flood insurance and they do an evaluation,
Yes.
do you have to submit that if in case you're paying less already?
Right.
Or is it automatic once you've done it, it goes into the system? Can you explain?
No, there is no system.
There, yeah.
So the homeowner gets that elevation certificate, it's theirs, free and clear, it's theirs. They can take it to an agent can do the comparison of what the two rates are, and by law, they must charge you the lower of the two rates. So even if it's that subsidized rate, they must stay with that subsidized rate, and the homeowner can put that elevation certificate in a drawer and just leave it there. The value remains that they do have a view into what that full risk rate is, because those subsidized rates will keep increasing until they reach a full risk rate.
Right.
Other question, I'm sorry. In terms of the elevation certificate, is that something that is going to be mandatory, do you think, in your opinion?
I mean, to the best of my knowledge right now, it's not there, you know, it's actually not very efficient because it's home by home and you need a person to actually do the measurements. There are other technologies where you could get at some of that information, and those are proposed in the reform bills that FEMA should be using those new technologies.
That's part of the 2.0 package?
It is part currently of the sort of, there's pending legislation that's been introduced in Congress to actually reauthorize the program and reform it. That hasn't actually gone anywhere. And some of that legislation that's sort of pending right now includes these technologies like LiDAR, so doing a digital, yeah.
Yeah, yes. We had another question over here, and then we had somebody in the back as well.
It was more of an observation that in the last year, I come from Long Beach, New York, and where a lot of homes were elevated, I noticed that while they got the grant to elevate their homes from New York Rising, they were in FEMA compliant, finally, but then the government, the state government and the local government taxed them on the fact that they had new construction now, even though they elevated their homes. So I'm just wondering why the governments are not talking to each other and saying, we mandated this to, for homes to be lifted because we wanted to raise the base flood elevation, but at the same time, now we're taking back by taxing, you know what I mean? And then my question to you was that local insurance agents, shouldn't they be finding ways of reducing the rate that current owners pay when they are I want to say, for lack of a better word, misrated. Because I've seen a lot of seniors in my community pay as high as $6,000 a year, and then when they go to sell their home, the new buyer just comes in paying maybe $1,200 a year because he went to a different insurance agent. And then I say to myself, well, why couldn't the senior capitalize on that reduction? It's the same rate by FEMA.
So there are a lot of challenges within insurance to understanding how sort of the whole program works. If you sort of input the wrong value somewhere from an elevation certificate or just on the surface, it can cause a drastically different rating. And so one of the things that everyone sort of wants to see is increased training for these insurance agents on the ground, so things like that don't happen, because there's really not a mechanism to stop it currently.
Right. So the way that we talk to consumers about this is we kind of take a buyer beware approach, and we advise people to talk to 3 agents and get 3 different quotes. Even though it should be one quote because it's set by the government, we still tell people to talk to different agents and get different quotes because it really can vary. And that way, at least, you know, you can be sure that to some extent that you're getting the lowest rate. And just one point on your tax relief, if the elevation was a result of Hurricane Sandy, statewide, there should be relief for that kind of double, you know, getting hit twice. But I would urge people to, you know, look into the particulars. In Long Beach, we focus so much on just the 5 boroughs, but I know that the state had extended that relief program.
I just one more comment. Just as a real estate professional working in the area, I find myself being the flood insurance go-to guy to reduce the flood in some areas. When somebody wants to sell, I find myself going first to the tax guy, the property tax grievance guy, to file a tax grievance, and then I find myself putting the flood insurance quote that I got from the insurance guy, and the tax grievance guy gives me, you know, the projected decrease in the assessment. And this is all preliminary to the start of my listing. And I'm wearing 3 hats, basically.
You're full service.
Yeah, and
You're kind of our best. But
I have to tell you, since Hurricane Sandy, where I literally was in the water, literally, I'm kind of disgusted. You know, I sit here and I go to classes on flood, and then I wish somebody like yourself would admit finally that the system was broken, and that I don't think there's an answer that Congress can give. Now you're saying that flood maps are not going to be revised till 2022. We were promised after Sandy that they were going to be revised within a 2-year period. I don't see 2022 coming. And this flood 2.0, I think, is much more on a larger scale than we all know. And I think there's going to be a lot of homes for sale come April of 2020. That's just my opinion. Sorry.
Don't apologize. It's, I mean, part of why we're doing this is, you know, we wanted to share this information. We also really value the real estate community in our work, and so we would love to kind of hear from you on these issues and anything that you found particularly helpful, any resource that you think would be helpful, anything you're hearing from your clients that you think would be helpful. We would love to work together on that as well, because we need you all to help, because you're the point of information. I had a question in the back, and then we'll come over to you.
This is an upstate thing, but
yes.
Flood insurance is flood insurance.
Yes.
This is a plug for the elevation certificate. we had a listing, it was a beautiful property, and it was on the lake, and we had the hardest time because it was over $4,000 on the insurance. So we suggested that our client get the elevation certificate done. Wasn't even aware of what it was. You know, he didn't have a clue about it. And it went from not just reduced to eliminated. It literally eliminated his flood insurance after the certificate.
Yes.
He immediately sold the property. And actually, we did quite well after that. And I think in his mind, first he wasn't aware of it, and then secondly, it had a basement. So he's thinking, well, I'm certainly not going to make the elevation grade.
Right.
But the basement wasn't finished.
Right.
So
Right.
where he was, as far as the living area, is what you just said, he was well above it.
See, that's fantastic.
And unfortunately, he paid about 12 to 14 years of $1,000 plus.
Yeah.
So
Yeah.
that's a plug. Knowledge is power. Let your
Yeah.
mind know.
Yeah.
That's
That's,
great.
yeah.
Okay. Yes.
I've experienced the same thing too, so that it really does work. We often have like from properties that are obviously not in the floodplain, and elevation survey, and in our area,
How much is it?
demolition.
Yeah.
And so that's, my question was really quick though. I wanted to clarify something you said and make sure I had it right. You said once the property has had flood insurance, it will always be required?
It is, so if there is a federally backed mortgage, so long as the federally backed mortgage is in place and it is in a high-risk floodplain, the 100-year floodplain, it would be required to have flood insurance. The one that is required in perpetuity is if it received federal disaster assistance, so money from Fema or HUD or Small Business Administration. Once a property has received that assistance, no matter who the owner is, they look at it as the property, and so then the requirement is there in perpetuity.
Right. Thank you. Right. And then just another note about continuity with policies. For any of the subsidies to stay in place, for any of that grandfathering we talked about buying in, if you're in moderate risk and it moves, the policies also need to stay current. And again, they can be transferred from owner to owner.
Thank you.
Yes.
Is the flood of New York only for the boroughs, or is it for all of New York State?
It is, the address search right now is only for New York City. A lot of the information on the website is applicable everywhere.
But then FEMA has one that we put the address.
Yes.
Yes. And those are on the resources
Yes.
handout that we
Yeah.
gave? Yes.
Yeah.
Yes.
Any other
Any other questions?
last questions?
Okay.
Okay.